On today's Hashi, I'm discussing Zillow's fall housing market outlook, rent prices, mortgage demand, and private payrolls. Today is Wednesday, October 4th, 2023. I am Byron Lazine, and the hot sheet starts now. Okay, welcome back to the greatest show on turf. That would be the Rams a la, I think, 2000. This would be the greatest show on the internet for housing. It's the only one that goes live every single day that the markets are open live, 9:30 on the East, 6:30 in the West. So thank you for joining me. If you're here on the live show on YouTube, let me know in the live chat which market you're tuning in from. If you're on the replay, happy to hear from you as well on your comments. We look at those throughout the week and every single Friday on a free format Friday. We can address some of those questions. We have a new wrinkle for this free format Friday at the end of the week. So I can't wait to get into that with all of you. We've got a whole bunch of topics lined up for today's hot sheet. Very interesting times in housing, of course, as we enter quarter four in 2024. But I don't know. Bobby found something just was hilarious to me. Bobby, our lead producer here at BAM. And before we get into the topics, I mean, we've got the Zillow fall housing update, which is actually quite interesting. I think there's some key data points that you can share, especially if you're an agent with your buyers. Some mortgage demand talk. We got a lot of stuff to cover. But Bobby, this is just hilarious. Jerome Powell on the internet. Play the video.
The Fed is America's central bank, working to promote a healthy economy and a strong financial system. That mission starts with you. October is National Economic Education Month, and throughout the month and beyond, we'll be posting here with information, links to events, and other resources about how Fed decisions affect you, your family, and your community.
So you can read in the copy, the Federal Reserve is now on Instagram and Threads, and Jerome Powell called himself J. Powell, so really making sure he's one with the kids, making sure he's educating the youth of America leading up to the October 31st and September 1st FOMC meeting. Jerome Powell and the Fed now on Instagram and Threads, if you were wondering. I found that quite hilarious. And it was the first time, in fact, that I've heard anybody mention Threads in like 2 months. I don't know about you, but Threads seems like it's a ghost town. I don't know if you're using Threads, let me know. But apparently Jay Powell is on Threads. Doesn't seem in that Instagram video too worried about where we are with inflation. So I don't know. Maybe that's a signal that they're gonna just stay chilled out here at the end of this month. Maybe he's not gonna do anything. I hope he doesn't dance. I don't know why he didn't get on Twitter X. It's where most of the people that are concerned about the economy are. But maybe it's because he's got Nick T from Wall Street Journal as his little puppet master, and he leaks information. Nick T on Twitter X usually, shows the FOMC's moves before Jerome Powell even does them. So I don't know. Maybe that's why he avoided Twitter and he's just on Zuck's new Threads and IG. Anyways, I digress. We go to Zillow and their fall housing market outlook. Zillow says the market is cooling quickly. It's the headline from their media piece. The seasonal cool down for housing market is shaping up to be extra chilly this fall, swinging negotiation power toward buyers. Okay, is that going to be true overall? Is it going to be true for your market? And if that is true, what can you do if you're an agent to capitalize on what I would call an opportunity and make sure you educate buyers on maybe a moment in time opportunity for them? We'll talk about more of that. This is Jeff Tucker from Zillow earlier this week. Competition in the housing market cooling off remarkably fast. We're going to talk about mortgage demand at the end. Love to know in the live chat if you're seeing competition cool remarkably fast in Zillow's words. Would you echo that statement in your local market? Even for this time of year, this is a time of year, remember, real estate's cyclical, real estate is seasonal. And this is the seasonality where you do see demand naturally start to drop this time of year in quarter four. It goes on to say sellers are cutting list prices more often than any time except for last year. Okay, so last year, homes were being cut on prices at a higher rate than this year. Okay, so does that signal a stronger winter market? The drought of new listings, which has kept options scarce and competition high, eased a little bit this last month, but still, we're talking about 13 straight months of the lowest new listing data ever recorded. You can go back when we talk about this every single Monday. The Altos research shows it clearly, and Zillow's data is also showing that. So we'll go to new listings here as well, according to Zillow. But first, let's just take a look at what they're saying is happening at the highest rate, except for last year. That's the weekly share of listings with a price cut. You can see here, if you're watching on YouTube, the chart 2023 is leading the other dates that they have here, which is 18, 19, 20, 21. I got to say, when you go back into time of the 2009, 10, 11, 12 era, there was a lot of price drops. And you know what there was that's not happening today? There was a lot of days on market. Okay. There wasn't nearly as many buyers in those days. And by the way, we have higher interest rates than those days. So it tells you a little bit about the pent up demand and the reality that this market, if and when prices or rates in the future go down, you're going to see demand pop again significantly because of this lack of inventory. But 2023 certainly above 18, 19, 20, 21 on price cuts makes a lot of sense. Those were vibrant years. But still well below 2022. This time last year, we were experiencing more price cuts. This time last year, we were in the low sevens on interest rates. This time now, you could get quoted at 8%, depending on who you are. We set the record, or set a new high rather yesterday for the 30-year fixed, going all the way back 23 plus years. Yesterday was the high, yet we're below last year's level on price cuts. Last year, it was a stinging experience when those interest rates jacked up. Now we've been dealing with it for over a year. The housing market has absorbed, it's taken the hit, and you haven't seen prices on sales really reflect that last year of increasing interest rates. Okay. Now, are we going to see something going into this winter? I think we will. I think we're going to see a pullback a little bit on prices, because we always do when you look at the winter months. No matter what the market does, in a hot market, in a low market, you see a winter slowdown on price growth, or even a decline. When you look at that moment in time, you can go back into, I'm sure your MLS or any other data source that you like to use can show you the last 20 years. Charts are up and down, up and down, up and down on prices because of the seasonality of real estate. So I expect prices to pull back. I do expect year over year flat or maybe a little bit up. Zillow was talking about 6% increases. They've now lowered that number for the next 6 months. But going back to the weekly share of listings with a price cut, this is going across the US. I'll throw out a couple of key markets that we like to track. You can throw some into the live chat if you'd like me to go to those markets on price cuts. I'll switch over now to Austin. Austin is well below, ticking up in the last 30 days is the trend, but well below 2022's numbers, even a wider gap on price cuts from 2022 to this year for Austin, Texas. Moving along, we'll check out a couple other key markets. We'll check out Boston, Massachusetts. Boston price cuts tells a completely different story than the rest of the country. And this is what's going on in the Northeast because of such low inventory. Boston is not only below 2022's price cuts, but 2023 sits below 21. It sits below 2019, and it sits below 2018's price cuts. So Boston's price cuts are not, they're ticking up in the last 30 days. Yes, and you saw a spike there in September. You're starting to see it in Boston, but it's still well below the previous 5 years outside of 2020. Okay, so, or I'm sorry, 2021. 2020 was in fact higher on price cuts this time of year for Boston. So that shows you the Northeast is reacting much differently than other parts of the country. It's because of how low the inventory was. When we looked even yesterday at NAR's data on pending sales, you saw that the Northeast numbers were dropping the most, and it's because there aren't many homes available to sell. We'll go to AE Caniff. We'll go to Jacksonville. And you see here, Jacksonville is increasing over the last couple months, decreasing here the last 30 days or so, but well below 2022's number of price cuts. And you saw at the end of the year, 2022 for Jacksonville, that number really dropped down to, the average of the last 5 years. And so Jacksonville below last year's, it's going to have to drop quite a bit here in quarter four to be on pace with what happened last year, but well below the prior year. We'll go to let's go to Denver. Denver major market here. Look at Denver, really in line with 2019 and 2018, well below last year's on price cuts. So they're happening in Denver, but nothing that I would say is really out of the ordinary just yet. And in fact, the last couple of weeks showing a decline there in Denver. Okay, let's go to the West Coast here real quick. Well, let's go to New York. We got New York. We got to take a look at that. New York showing this is the signal of what's going on in the Northeast. Okay, you're in the last 5 years, only 1 year, 2020, is below this time of last year or this time this year. And it's just below everything else on price cuts, weekly share of listings with a price cut. 2020, 19, 18, 21, 22, all above in New York. It shows you how starved, again, the Northeast is for inventory. It's the most starved region in the country. I know Jody wanted us to go to OKC. OKC is showing higher this year than last year, just above on the weekly share of listings with a price cut. So OKC is a market where they're experiencing more price cuts than they have at any point in the last 5 years. This is really highlighting how local you got to go with this data on the price cuts. Okay. So if you're talking to a seller, and they some want to do a price increase at times. But if you're in OKC, that's a bad move. You got to compete with the competition and keep up. And it's likely a price cut in a market like OKC right now if you've been on the market 45 days. Remember, 45 days used to be normal. Okay, if we go past 45 days now, buyers are not accustomed to that. There's going to be a lot of questions. You could even, some markets argue that 30-day would be the moment of consideration. Rule of thumb used to be 60 days. I think we're a little bit more shallow than that on price drops. Okay, so new listing drought, according to Zillow, has modestly improved. If we take a look at their data, year over year, we're down 10.3% on new listing data. In fact, Altos always says in the last 13 months, we're at the lowest level ever recorded, but we're starting to hopefully find the bottom. Of course, the bottom seasonally in quarter four continues to go lower. So we're holding pace here, just under 80,000 right now. This time last year, we were above 80,000 on weekly new listings. So Zillow really saying the same thing Altos is saying that we look at every single Monday. We're at an all-time low here for new listings. It's one of the things that's keeping prices obviously up. If new listings were at normal levels or above, that would be, with more inventory, more options for the buyers who can afford, that would be something that would push prices down. Until we see inventory go up, it's hard to make the case that prices are going to drop significantly overall. There could be some market conditions that would change that. Weekly for sale inventory down 10.7% year over year. We're at the lowest pace of the last 5 years. So inventory now the lowest we've seen even when you look at those crazy markets of 20, 21, and 22, we've got lower for sale inventory happening right now. We'll take a look at a couple key markets on this one. I think it's interesting to take a look at Austin. And if you look at Austin, that chart completely flips. Now Austin just below 2022, but above 2021, 19, and 18 on weekly for sale inventory. Year over year, they are down 4.6% over there. If you take a look at Boston, like I've been saying in the Northeast, you're going to see a completely different picture, well below 2018, 19, 20, 21, and 22. It's not even close, down 24.9% year over year on weekly for sale inventory. The Northeast is getting annihilated on for sale inventory right now. I can go to New York and I would imagine we're going to see the same thing. There you go. There's New York, well below all of the last 4 years there. I think I saw New Haven, Connecticut on here. Let me click on that one. Yep, same exact story. Look at the 2000. Just look at this. Is the Connecticut's such a unique little market. Look at 2018. How much inventory there was in 2018. Connecticut really didn't come back in many markets till 2019. It started making some moves, but it was really 2020. I mean, look at that, how high that is in 2018, and then compared to how low year over year in New Haven, Connecticut, down 26.3% on weekly for sale inventory. That, folks, is worse than Boston. Why is this happening? Zillow says. Well, most likely the cause for a late summer pullback in demand, well, it would be because it always happens, Zillow, is the same force that's been in the driver's seat for well over a year now. It's the mortgage interest rates, but it's also the time of year, Zillow. Okay, you got to acknowledge that. You go back 20 plus years, the seasonality of these markets suggests that buyers are going to pull back. Okay, so Zillow says they climbed higher. The rates in August, 30-year fixed rates have been above 7% for 6 weeks running. We hit 7.7 on the daily survey yesterday, further discouraging home buyers right away as many step away from house hunting to buckle down for back to school and holiday planning. And that's the seasonality part that we always see. There's a case, though, and Zillow kind of makes it here. What's next? What's next for buyers? Here's the case that could be made. That what's next is future bidding wars and more uncertainty on new listings. Okay, the share of homes that sold for more than their final list price has been gradually declining from a peak of 41.9% in the week ending June 24th to 38.3% the week ending August 12th. I do imagine that number of homes that sell more than ask is going to continue to decline throughout the year. That number should even get below 30% when we start to look at the end of the year. It could be even lower. If the rising share of price cuts serves as a sign of changing tides in the market, it's safe to expect fewer of these above list price sales in the weeks ahead. I agree, Zillow. Okay, this is something, if buyers can understand that, and you're in the market now, you're walking into a market that is going to start to experience less over ask opportunities in most markets. I get it. When we look at those Northeast markets, it's going to be heartbreaking for some buyers there because of the inventory. But the other regions in the country have a different story to tell, a different story that's starting to build. Last winter, we observed that higher interest rates seem to discourage sellers as much or even more than buyers. Now that pattern, Zillow says, is breaking in August and September. That's the signals that they're projecting out for this fall. It's too soon, though, to tell if that is going to continue. So one thing, if you can afford, I've been saying it, if you can educate buyers that, hey, if you're in position to afford the house, go ahead and continue to look this winter, because you might be getting yourself a unique opportunity. If people are on the market right now, they have to sell, okay, in the winter. Or they really want to sell. They have a strong desire. They're listing this winter. They've got a strong desire to do so. And you could be in a position where you've got less competition. One of the things you may think about saying to people that are sitting on that fence that also, have a home to sell is, if you sold your house, could you buy the next one cash? Because why? We're seeing cash rise. We're seeing cash offers now, deals rather, pendings go up again. We're seeing that increase because of the interest rates. So if you're speaking to homeowners where it's like, hey, if you sold, are you in a position financially to buy the next one cash? Here's why that could be important for you. You're going to have a great negotiating opportunity. Real estate is cyclical. Every market this winter will bring the lowest price points. This year is no different. And oh, by the way, besides this advantage, what do you imagine will be the case when interest rates do at some point go to 5 or 6%? Do you anticipate that the market will bring more or less buyers looking at homes? Oh, you think more? And do you anticipate that in that environment, just based off of economics, you're going to see prices increase? Most people are going to agree with that. Okay. What's not increasing finally is the apartment rents. Been saying this since March, since Barry Sternlight and others foresaw the inventory in multifamily apartment buildings coming down the pike. Jay Parsons, who covers on Twitter X the U.S. apartment market very closely, just sent out paragraph upon paragraph into the Twitter X sphere here. Apartment rents in the U.S. are barely hanging on, rising just 0.1% year over year through September. Why is this important, folks? It's because shelter makes up 35+% of the CPI. And if we can get the Fed to get off of threads, if we can get Jay Powell to get off of threads and recognize this real-time data, we might be able to look at CPI and inflation a little bit differently. Many key markets, especially on the West Coast and the Sun Belt, are already in the red, meaning they already have negative rental price year over year. As Nick T from the Wall Street Journal put it recently, this is disinflation without demand destruction. We haven't seen in rental housing for decades. Without demand destruction, you're actually still seeing demand for rental prices or for rentals, but the values are coming down. The rent prices are coming down. I think you actually could see an increase in demand from today because as some buyers decide, I'm going to rent for another year because I'm getting such a better deal on my monthly payment there than I am in the most unaffordable housing market as we sit here in October. You're going to see some of that. The great advisors are going to look at some of their, clients and actually put them in a position to do that. Now, the ones that can buy cash or can afford the mortgage payment comfortably, you want to actually help them go ahead and buy, but it's different advice for different folks if you're a real estate agent, of course. But I think you could see an increase in demand for renters because of where the housing market is, as well as a consistent lowering in price. We have so much inventory in rents. Think Nashville, think Austin, think Tampa. These places are about to get hit with a huge amount of inventory at the end of quarter four, beginning of quarter one on brand new apartments. So Jay Parsons on Twitter gets asked why rents are cooling so fast, giving rental tailwinds like a strong wage growth and low unemployment and higher barrier to entry for home purchase. So the rent versus own comparison makes renting look like a bargain. And quite frankly, it just does on a month over month basis right now. That is completely flipped from where we were in 2021. The answer isn't complex. It's not about demand. It's not even about affordability. It's a supply issue, and operators are competing for heads in beds. That when operators start to compete for what he's calling heads in beds, you're going to see lucrative options for renters. Hey, maybe 2 months free rent. Those are coming down the pike because these developers, these operators of multifamily don't want to have 10 plus vacancy rates. They've got to fill their space. And if they're brand new to the market, they got a whole building to now fill up. And they will be making really lucrative offers to the public to get those full. They've got to show the bank that they're full. They're on loans that they're going to have to refinance at some point. We're at high rates. Multifamily real estate operators are in a tricky position right now. Property managers are giving on rents in order to protect occupancy and cash flow right now. They need the cash flow to show the bank this is a business that you should keep investing in. No, operators don't make money on vacant units. There's a lot of demand, but even more supply. Apartment construction, highest level in 50 plus years. So this is the complete opposite of what's happening on single family. Why? Why do you ask? It's because our government doesn't respect home ownership. They want renters for life. They've made it really easy for apartment construction to take place, and they haven't made it as easy to go out and build single family units. It's very expensive to build single family units. So I don't blame the builders. I blame the places that they're building in, the American cities that we're building in. We talked yesterday about what the mayor in New York City is trying to do. So somebody's trying to do something. Completions in quarter three were higher than any other since the mid 1980s. Okay. Now, Parsons wouldn't call it an oversupply. That implies a structural issue. I'd call it an oversupply in comparison to the supply that we have for single family housing for sale purchases. But a better description might be short-term supply demand imbalance. We're still structurally undersupplied on housing. Okay, you can see here the rent growth that we're talking about, despite strong demand, rent growth is now down to zero, or in some markets, like he mentioned, Sunbelt and the West, we're actually in the negatives, okay, which we haven't seen since the lockdown era. Remember those good old days? Wow, those were fun times. Okay, let's take a look at what this can do for CPI. This is an interesting chart. Of course, you can get all access to all of our charts. In BAMX, if you're a member, use code HOT to get 10% off of BAMX today. You get all of our daily downloads and the most of our content. CPI rent cools for the fifth straight month with deeper cooling to come. Hoping Jay Powell, as he calls himself, is going to take this into consideration as he meets on October 31st. Maybe he'll dress up like Jerome Powell on October 31st. He'll stop being Jay Powell and dress up as Jerome when they meet at the end of the month. So apartment demand, according to going back to Jay Parsons, suddenly looks normal. Quarter three, 2022, net leasing was right around long-term seasonal average, but shy of supply, with new apartment completions reaching the highest level since the 80s. And again, still more coming. So that's what's going on in the rental market. We can only hope that the FOMC is going to take that recent data into consideration. They certainly like this data, does the Fed. It's that mortgage demand has now dropped to the lowest level since 1996, just released this morning from Mortgage Banker Association. Interest rates heading towards 8%. Applications to refinance a home loan dropped 7% for the week. They were 11% lower than the same week a year ago. Applications for a mortgage to purchase home fell 6% for the week and 22% lower than the same week 1 year ago. Like we were talking about with the Zillow data, I wouldn't get too caught up on this because there's a lot of seasonality, and we are, as a result, just living in the lowest the lowest affordable housing market of our time. October has beat last September, which had this past September, 30 days ago, which had the record, which September beat the record of August. It's the most unaffordable market we've seen. That's why cash buyers and those who can afford the payment are the ones that should be making the moves right now, and others just simply can't. But it is the lowest mortgage application drop or level since 1996 there. Okay. Mortgage application payments slightly increased, just crunching the affordability even more. Mortgage application payments increased slightly to $2,170 in the month of August. So affordability declined with the national median to $2,170, up from $2,162 in July. Just announced this morning. This should be hopefully decent news for Jay Powell and the Fed. Private payrolls rose 89,000 in September, which is far below expectations, according to the ADP. The expectations down from an upwardly revised 180,000. I'm sorry, the 180,000 was in August, and it's below the 160,000 estimate from Dow Jones. This is great news because remember, we don't want private payrolls to keep rising because the Fed doesn't want it. And we don't want the Fed to continue a restrictive policy that actually breaks the labor market. I think I said housing, I meant labor market. We actually don't want them to break the labor market, because that means people go out of jobs. Remember, Logan Motoshami from Housing Wire suggests that we're going to have to see over 300, mid 300,000 on unemployment. We're much lower than that. We're at about 200,000 for the Fed to be satisfied. This at least helps the case. And in fact, today we've seen a Treasury yield on the 10-year retreat a little bit off of a just wild high yesterday of going now up over 4.8, almost 4.9 yesterday. But the Treasury yields do retreat from a 16-year high after this weaker than expected ADP jobs report. So at least the market is responding to that favorably. The 30-year fix did not respond favorably to where the 10-year was yesterday, closing out the day at 7.72. Certainly the highest that we have seen in 20 plus years on the 30-year fix there. Okay, the 10-year as we sit here today is at 4.747 on the Wall Street Journal tracker. 4.747. We got up as high as 4.887 yesterday. The 1-day range went from 4.579 to 4.887. So volatility on the 10-year is a real thing. Higher interest rates for longer is seemingly a certainty moving forward. You can go back, re-listen to yesterday's hot sheet for some of the revised projections on where we will end up. And I hope you enjoyed today's show. Bobby, I said it was going to be a short one. I think it was a longer one. Unfortunately for me, because I have a hard stop right now, but I appreciate all of you guys. To get the most out of our BAM content, join BAMX. We've got a YouTube accountability group starting up today in the BAMX community. So if you want to take your YouTube game to the next level, make sure that you're in for that. You can get 10% off your BAMX membership by using code HOT. Get 10% off and get the most out of all of our BAM content. Have a great day. We'll see you back here tomorrow, 9:30 on the East, 6:30 on the West. Until then, toodaloo.